right, thank you for tuning into the Starbased Podcast. This is your host, Tratium, along with Ouija, and today we're talking about governance. So let's kick it off, Ouija, with a state of the market update.
Okay, so quick kind of update on the market. We're seeing BTC trade around kind of 19,500, give or take. So we're below that kind of 20,000 mark that we're all hoping to maintain. ETH is currently at $1,050, but it has dipped to the three-figure mark by the time we're having this conversation. So that was on the weekend. We've seen the US CPI print. That's 8.6%, the most recent one. So we're looking at a 2 to 10 year kind of bond yield, and that's an inversion. So things aren't looking super stable at the moment. Doesn't look like we're reversing in trends. BTC is still correlated with TradFi. We're seeing kind of multiple market metrics suggesting that things are oversold, but we're not changing direction anytime soon. So it can get a little bit fuzzy out there. And I'm just going to break down a few specifics that are going to help you kind of put things into perspective, as crypto Twitter and things like that can get a little bit confusing sometimes, especially with the conflicting bullish and bearish sentiments. So we're seeing a realized price of BTC, and it normally floats around 23,400-ish, around that mark, which basically means the average price of every coin in supply. And that is a big indicator for many, many investors, both short-term and long-hold wallets, especially the long holders. We haven't seen these levels since 2018 and the 2020 March drop. So these are significant levels we're seeing tested, and now we're dipping below them. The liveliness metric, which is basically how the coins trade, so how likely are they to trade between exchanges, wallets, and things like that, that's still remaining in a downtrend. And that can sometimes reflect general market uncertainty and de-risking of positions, which is something we're seeing now. It defines the balance of coin destruction and creation. As well as that, we're seeing the accumulation trend continue for the past month. That can sometimes be termed as bullish. However, we're seeing a decline of 64% over the last month as well from holder positions. So that's kind of a conflicting one, but looking like it's bearish as well, unfortunately. And then we're seeing the shrimps and the whales and the sharks and the crabs have a little bit of a war. Basically, just to break this down is how I think of it, is a shrimp is anything below 1 Bitcoin. A whale is anything over 10K Bitcoins. And crabs and sharks are somewhere between 1 Bitcoin to 100 Bitcoins. So that gives you a sense of the scale of those wallets. We're seeing whales and shrimps actually kind of aggressively accumulate Bitcoin recently, which is good, considering the kind of recent price decline. However, we're seeing the crabs and the sharks, so between those 1 and 100 Bitcoins, they're starting to distribute, which means there's a decline in confidence. They're starting to sell. They're getting a bit worried. The bulk of holders sit somewhere within those normally, the ones that kind of create the market liquidity of the flow. We're seeing realized capital gains. So the RVT ratio, which is realized capitalization to daily volume, that's settled on chain. So I'm looking at on chain metrics for this. It's sitting in the highest since 2010, and that's pushing bear country. So the way to think about this is it's basically a network valuation, and it's indicating an oversold, which means it's in relative to the network activity. When you're looking at RVT, if you look it up, high values with uptrends indicate poor network utilization, and the network is slowing down. That indicates that it's not got network growth. That's a bad thing for Bitcoin. I'm going off Bitcoin because it's a leading market indicator. It's the biggest one that we can see, and it's the longest living crypto. Low values, downtrend, indicate high utilization, high network uptick. That's good. If we sideways, if we crab, that's okay. That's sustainable. We like to see that too. But so far we're seeing this high uptrend with high values. It's not a good sign. Bearish again, unfortunately. To go back to the long-term holders and the short-term holders, we're seeing many long-term holders spending coins with their kind of higher cost basis than the short-term holders. Again, they normally have a low cost basis on chain, which means they normally pick up these coins low cost and hold for a long period of time. Seeing them trade is normally a bearish indicator. It indicates that they're barely profitable, and that means that kind of miners, exchanges aren't as profitable as they used to be. Another bearish indicator. So normally, when we've seen these in the past, all these kind of indicators, especially the kind of long-term holders to short-term holders and how they're operating, unfortunately, that behavior coincides with deep bear market behavior that we've seen previously. I'm just going on the data that we've had, before, and it normally indicates somewhere between another drawdown of between minus 40% or another minus 65%. So hold on to your socks. We may go dipping again. In terms of a summary, like I said before, Bitcoin, we're still in bear market territory, bear country. So be careful if you're trying to trade. Not financial advice. And obviously, we're seeing a barely, a cost basis, an aggregate cost basis that's barely holding. Again, bearish. On-chain fundamentals continue to deteriorate. Although macro term, I would personally say we're still looking great. Nothing on that fundamental macro basis has changed for me anyway. So I think long term, I'm still very optimistic for Ethereum, Bitcoin, etc. But this phase that we're entering, in the past, it's taken between 8 to 24 months before we bottom out. So that's what we're seeing on chain. We're seeing what seems to be coming up for the final washout of sellers. So watch out. Yeah.
Yeah, and this week we've seen quite a lot of liquidation drama on chain, especially regarding like Chainlink oracles. Having they have a slight delay or like a moving average that they follow when actually reporting the on-chain prices. And there's been a couple times where the oracle has gotten to like within like 1% or even less than that of a major multi-$100 million liquidation price on Aave and other lending protocols. Yeah. And just by the skin of their teeth, the depositor, escapes without being liquidated, which would have sent, ETH down another leg. But it's kind of hairy out there. So yeah, I agree. Hold on to your socks.
Yeah, I mean, and like you say, it's come within a hair's breadth of having those huge liquidations, and it's how long can those positions stay solvent? Yeah. We're seeing the 3 Arrow Capital, what's close to 400 million liquidation threat, massive leveraged longs. Their clients wanting to redeem the deposits, they can't redeem them. They ghosted their clients, and now they're being like hunted. It's worrying. It's worrying.
It is. I mean, the word of the day is contagion. And yes. 3 Arrows Capital being like seemingly the biggest player in crypto, for the biggest voice, biggest player, like obviously throwing around the biggest size we've seen maybe ever in crypto. And for them to go kind of belly up and then start ghosting their lenders is unheard of. Like this has been the craziest past couple months in crypto I've ever experienced. And I've been here since the beginning. And it's just like, the institutions have come and they have swung around some pretty impressive movements. But yeah, we'll see what happens with 3 Arrows. And to kind of pivot us into this like liquidation talk in relation to like governance, something very interesting happened this morning, where on Solana, Solend is basically like the Solana version of Aave. And they just voted to pass. And when I say they, like it's like a single or maybe like 4 major token holders that have basically unanimously voted this, despite maybe the kind of hate of the community. But there is a maybe like 200 and something odd million dollar SOL position on chain that is again within spitting distance of being liquidated. And Solana, not to shit on it too much, has gone down a lot over the past year, and its kind of chain liveliness is not really that impressive. And on top of that, there is not enough on-chain liquidity of SOL to be able to handle a $200 odd million liquidation. So the fear is if the price of Sol dips, I think it's currently around $32. If it dips down to like the liquidation price of I think 20, 22, 23, then this will trigger a multi-hundred million dollar liquidation that there is not liquidity for on chain. So the liquidators will not be able to handle it, and there's fear that the chain will actually like break, in some form. I think there's another situation like this earlier maybe last year that was kind of similar, but the issue is that the chain might not be able to handle it and it would cause it to break, or there need to be more coordination to get it up and stuff.
It wouldn't be the first time they switched the chain off.
Yeah, it wouldn't be the first time they switch the chain off. Yeah, there is literally a like, no, not literally. There's figuratively a light switch somewhere that turns Solana on and off. And I do think it's a chain that has its uses. So I don't want to don't shit on it too much. But so the kicker is that the DAO, meaning these like four major voters with like 98% of the tokens, have voted to basically unilaterally take control of this single depositor's funds. So that this is just a entity that has like, it's kind of like it's like the tetranode, RIP, the tetranode of Solana, and he has this $100 million position on Solend, and he has not like added or tried to lower his liquidation price for like 2 weeks now. And so people kind of think that either he's like not playing ball or that he's asleep for 2 weeks or in a coma. And so the fear again is that it dripped down that liquidation price and then the whole chain breaks. And so the DAO has voted to unilaterally take control of the funds and sell it over the counter, which is insane in my mind. Right?
Yeah. So yeah, it's mad that you've seen that. It's crazy. If that happens, if the liquidation happens, it will be the same thing we saw essentially in UST, where there is only so much. There's a door, and there's only so many people that can fit through it with the liquidity. Right? That's unfortunately that will be that. Two, this is one of the risks we see, and Solana is a good I think a good network, a good blockchain, but it is centralized, and we're starting to see the really important, like the importance of a decentralized network. It's why Ethereum is so good. People prize decentralization, and it should be prized. Okay, this is one thing. But two, going back to the governance, as what our main subject is that we're starting to see just how obvious when you use a coin voting system or a token voting system, how those coins can be centralized. But luckily, you can see that a DAO can take control of that, but it can be used for nefarious purposes as well. But I would say that although that is the risk of that's when you put those two together, centralized and the coin voting. If you have a decentralized network, that'd be very hard to do. But it's the dangers of these combinations, I think. It's not that we have the solutions, but we're starting to see stress tests.
Yeah, I agree, and I think it's a hard problem to solve in governance. And there's kind of this meme that's like, oh, you put up a DAO vote, the founder of a protocol is like, oh, what color Lambo should I buy? Red or yellow? And then the community votes like 75% yellow, and then 25 the rest of it's 25% whatever else. And then the founder's like, oh, but I wanted red. And then he votes with his wallet, and boom, 98% red, right? Because like the founders, the OGs, like they hold a massive amount of supply of the token, and they can swing the vote whichever way they want. And that's a problem, on all networks. This Solend governance proposal is the most egregious example I've ever seen of that. It's very likely, FTX or something. I don't want to speculate too much, but it's very likely some big whale insiders that do not want to see hundreds of millions of dollars of Sol liquidated in this kind of a market condition. Which is probably also why we're seeing Sol hold up reasonably well during this past week. It's a green on the weekly, surprisingly, but I think there's again some infinite bids that are trying to keep it away from that liquidation price as this Solend kind of stuff hashes itself out. But yeah, it's there's governance is hard.
Margins are being called, and it's a tricky thing to see, and there's a lot of games being played at the moment. people hunting liquidations, and this is what happens if you overuse leverage, and it doesn't matter how big you are if you're irresponsible with it. And personally, I would say the Three Arrows Capital is a good example of that. Very big, consequences that are widespread for all of us, and it can be a silly thing to play with sometimes. But these are the games we play. Bad hands will be washed out, but it's a painful process. We've seen it before. This will be another event that will be painful. I think we have more to go. So on the subject of governance, we're seeing these coin voting systems, and like I say, there tends to be, although from what I see, there tends to be two main problems with the token system, right? You get these, like you said, these large holders, these large wallets, which means basically capital rules. How much money can you bring to bear, which means you have the position of control. It also goes hand in hand, unfortunately, with vote manipulation, which is something that you're saying. Again, you use the example of the kind of developer or the team, but it really goes for anyone who has a large amount of tokens for whatever reason, be them devs, be them a huge base of capital to use, and they can manipulate things both nefariously or not. And it's how do you produce a system that either helps or puts in place guardrails to do this, or has a mechanism for separating out, unbounding the economic incentives to the governance incentives. And that can be a very tricky thing to do. People have tried it in many different ways. And also, unfortunately, token voting has, in the past, definitely with Ethereum, which is the longest one we've seen, been correlated with low participants on chain, which is another one, is how do we solve that? Or do we need to solve that? Do we just need the more kind of educated or more invested players with the best intentions to vote, basically? So yeah, I mean, we've been going through some chats. I didn't make it to the chat that you most recently had in terms of Tokamak, which would have discussed a few of these things, I'm sure. We've seen things like quadratic voting. They've tried to use that. And I think that's a good solution, but we can see manipulation with that as well. So we can see multiple wallets be created to take part. Not hard to do. A way of solving that is through proof of personage. So that would require a KYC or a doxing event, which is people prize their anonymity on chain, and I think that should be a feature. I think that's important for people. It's definitely important for me. So it's a question of how do we get around that? Can we use third parties who are doxed or have proof of personage? Can we utilize the soulbound system? I'm not sure if you've done much reading into that. Soulbound system is pretty interesting. To accredit people with reputation on chain. Do they vote? Do they vote well? Are they active? Unfortunately, that has its downsides as well. I mean, what happens if you give soulbound tokens to a nefarious wallet and you give too many? So, yeah, I mean, there's lots of ways to cut this. It's a very interesting subject, governance. Yeah, I mean, I'm not sure what your thoughts are of what you've seen. You think are good solutions, or have you seen anything? I mean, downright bad solutions?
Yeah, I wouldn't say I've seen great solutions ever. I think there's only less bad solutions at this point. It's a tricky problem to solve, and I think eventually we will have better and perhaps great or really well done solutions. But maybe that's years away before we kind of hash it out. I think the fundamental problem, and this is kind of not just with voting, but like crypto in general, is the initial distribution of tokens, right? I mean, that's why that's one of the biggest benefits that Bitcoin has, is that initial distribution of tokens was very fair. And you see a lot of Bitcoin maxis complaining about like Ethereum being pre-mined and stuff, which I think is not as big of an issue as they claim, but it's kind of shows the point of how do you very evenly distribute tokens across a wide base of holders, because once you introduce governance, then that distribution matters a lot. And so pretty much all these solutions we're seeing, soulbound, quadratic voting, delegation, etc., are all attempts to solve that problem of initial distribution by limiting the power that whales have, or more equitably distributing voting power across individual users. I do think the best solution, ignoring the very fatal flaw of anonymity, is the proof of humanity, of a personhood, because that effectively ensures one vote per real life, real skin human being. Um, Again, the cost of having to dox yourself is, in my opinion, far too great for that to be a viable solution for basically any protocol. I think there are some, maybe CDFI kind of protocols that maybe that could be a decent solution for, but generally, I think you kind of got to ignore this one altogether, even though it does most fairly distribute votes. Maybe I think delegation is probably the simplest one that helps focus power to a small handful of contributors and team members and community members that the community trusts. So I kind of like what Alluvium is doing with their council, which I believe is, I want to say, 7 individuals that are voted on by the community, and they held, I think, like 7 rounds of voting to nominate and elect this council, and then individual token holders can delegate their votes to those council members accordingly, and so that does help kind of even out the vote distribution, I think, and kind of gives you, it's almost like a like the Roman version of like a representative democracy, where you have this kind of council. So I do like that as a interim solution until we kind of figure out something better, and it's also fairly simple from like an implementation standpoint. A lot of the DAO tooling that we have already supports it pretty easily, and it also helps resolve another major issue that you brought up, is that voter apathy. I as Tokamak has been kind of introducing the idea of governance, and I've been doing research and popping over to governance forums for other projects and stuff, and just like checking what's happening, what kind of proposals are happening, what makes it to the snapshot votes, what gets passed, and I was kind of surprised to see such low activity on a lot of these governance forums. And there's not that many proposals. Sometimes I scroll back, and it's like there's like been like a handful for the past 12 months. And maybe that's okay. You don't need to have votes happening for every single decision you need to make. Maybe have a very competent core team that's pushing through most stuff in the background, and then the community needs to vote on major decisions. That's fine. You don't, governments doesn't need to be micromanagement. But yeah, I think most individual voters don't want to like have to do research into a issue and then make a decision, show up for the vote, sometimes pay gas, sometimes not, but they don't want to have to like deal with hassle. And right. Delegation, I think, resolves that. I would certainly throw my hat in the ring to be, some sort of delegate for tokamak governance when introduced. I think I have some. I've spent a lot of time in the community, so I feel like I have some good opinions on things. And then that would allow the community to delegate to people like perhaps myself and others who they find competent or trustworthy, and then they vote on their behalf. So the end user doesn't necessarily need to constantly pay attention to what's going on, but the delegates do, and that's kind of brings it as almost like a job. And depending on how much stuff happens in governance on chain, it can be almost like a full-time job.
Right. So it absolutely is. I personally agree with you. I like the delegate structure. I think that is a really good way of doing it. We've not seen too many formats that I think are as good as delegation. There's different ways to delegate. So, for example, we have the token delegation, which is just simple, right? You get given the native tokens of that platform, and you use that to vote. You can also issue separate coins that are loosely weighted, to the token price, but they correlate directly to the governance of that protocol. So that's the attempt of the unbounding of economics from governance, almost. So those would be, we call them advisory tokens. It's a form of it, which we've seen some people dabble with, but they've not been fully kind of committed to, really. one of the things that I had actually earlier this week is an interview with a company which specializes in Web3 governance. So what they do is they take a position of delegation as a delegate for governance of these protocols, or they advise on them, and they don't get given, or don't always get given, the native token. So what they'll rather do is they'll take up a position of delegates and get paid a nominal amount to maintain that professional delegation position, or position of delegation. So they have this kind of this economic incentive to, and contractually obliged to vote in the best way they can, because that's their profession. But they're not making that money off selling and buying the native token, so they're not kind of intrinsically playing with that game. They're almost separate from it. And I like that approach. I also really like having the nominated individuals as delegates, such as yourself, for example. Another way that I've seen some people do it, or some projects do it, which I quite like, is obviously it comes back to the structure of a DAO, which I think should not be flat. I tend to think that's a terrible way of operating, personally.
Agreed.
You need some sort of hierarchy. Ideally, I would like that to be based on competence, but as well as that, reputation, as in how honest are you? Are you at least trying to operate in a benevolent manner towards that protocol? You can't embody the ideal, but you can definitely make a good go of it. And so the rising tide floats all ships. So you should try and act in a way that is going to be beneficial to everyone involved, right? Including yourself and others, and definitely the protocol, because you're all housed within that, or the DAO. So I think that you can also do this delegation to teams. So you can have certain teams within a DAO that specialize in different things. I've seen this mentioned in the Tokamak conversation, which I really liked. It's something that I personally think is one of the better solutions. And so you have these individuals. They may have a team lead, or they may be like a circle, a flat team, but they still operate within their circles of competence. And they come together and they have these like 7 teams, let's say, and each one has a vote, and they kind of work together to produce the ideal outcome, or the best that they can provide, without having this strange, what they call a futaki system. So you vote, if you vote badly, you get your tokens or your capital or whatever slashed. Basically, you are penalized for voting badly. But then how do you, maybe you're trying to vote to the best of your capabilities, but something goes wrong and then you get destroyed. So sometimes I feel like that's a bit of a nasty way of doing it. But I like that DAO structure. Yeah, I like the delegates.
I do too. Yeah, I think so the proposal that I submitted to, not submitted, but the proposal that I kind of put into the thread we have on the Tokamak Discord takes that idea of, I kind of got the idea from the Alluvium Councils and Yearn's Y teams, where you do have those kind of a combination of individual teams that each have their kind of area of responsibility. So you could have these competent core groups pushing forward their specific kind of area of responsibility, whether that's treasury management, DAO to DAO relations, marketing, community management, whatever it may be, development. And then the lead for each one of those individual teams could also be like a what I called marshal, like a council member, a team lead, a delegate, because then you have a combination of responsibilities of the delegates are responsible for voting in the protocol in the user's best interest, but they also have responsibilities to like kind of manage their team. So it's it kind of adds on an additional layer of responsibility there that I think benefits everyone, and they kind of these people are going to be involved in the protocol anyway, so it kind of ties their kind of job role to their kind of voting responsibilities, and I think that's kind of a good way of doing it. And you definitely, what we've seen overwhelmingly in the past year or two, is that these flat DAO structures fail every single time. They never work, and that's, people try to do that at first, right? It was kind of, it seemed like the most obvious solution for like the romantic idea of how a DAO should work, right? Like everyone is equitable, everyone has the exact same power, everyone has the same vote. There's no teams. It's kind of like the initial like open floor plan Silicon Valley kind of idea. It's like, there's no bosses here. Everyone's your own boss. It's like no. that sucks. It doesn't work. Nothing gets
Yeah.
done. It's death by a thousand paper cuts. It's every single decision is micromanaged and try to like picked on and stuff. And then you have uh, the voice of the people, which maybe does not have a lot of expertise a lot of times, having kind of being an anchor, kind of dragging the rest of the DAO down as they debate things that maybe they don't know that well. So I say kind of leave the expertise to the experts, and that's why I think delegation is definitely the way to go.
Yeah, and it's this thing where you see people who mean well. They take these ideals, and I love them. I love the ideal of a DAO, but there's certain ways that are not practical. And in the way that we go about it, like in the crypto sphere, for example, so much is economically driven. Whether people would like to think about it or not, it's just not. It's not practical. People will just take that ideology and they'll just manipulate it. And so it's not the best. It's not the best way of going about things. There's also something that I wanted to note, which is you have different levels of governance, or different impacts. So, for example, this can be specific to each protocol and how you go about it, but it's what does that DAO dictate? What decisions do they make? For example, in Tokamak, for example, does the DAO decide on emissions? Do they decide on actual kind of improvement protocol, like proposals on the protocol itself? And it's a question of, I don't think a DAO that just kind of can control everything is the best thing. One, when people say that is the way, oftentimes it's not, right? Because the team makes the final decisions and it's not really decentralized in that way. So that's just a lie, whether people like it or not, unfortunately. But I think it's a good thing to have the votes that have to be made off-chain. The important things that will impact the protocol, if possible, should be made off-chain. Things that can be made on-chain that is not going to destroy everything can be made on-chain. Community things, many different decisions can be made on-chain. That's brilliant, but you have to have this separation. Not everything can be on-chain. For instance, if decisions in Ethereum were all made on-chain, when they had to fork, that was Ethereum gone. Poof.
Right.
But because decisions could be made off-chain, they had that decision to make Ethereum Classic, and the new Ethereum went on its way, or the Ethereum that we know today. So I think that's a prime example of why these things must be done in a certain way. It's protocol specific for sure, but I think there's certain setups that only really can be, operable.
Yeah, and I've two examples that have come to mind as great examples to highlight the off-chain versus on-chain kind of decision making and when it can go wrong. And this one's off the top of my head, so I'm trying to recall the exact details. But Compound last year had some sort of a bug that caused a vote to pass that had some sort of like almost infinite mint of the comp token. And that was a governance structure that was entirely on chain. And by on chain, that means when a vote passes through Snapshot, code is like it triggers, an if else in the code that does if this does that. That resulted in a massive inflation bug on Compound. And it wasn't for 7 to 14 days where the next vote could be held to like undo the damage. So the team, the users, Robert Leshner, the guy who created Compound, like everyone was just like sitting back, like there's nothing we can do. 300 million new comp tokens were just minted on because of this governance proposal, and no one could do anything about it.
Yeah.
And so that's an example of something on chain going wrong. And when the machines are wrong, right? When the code is wrong and there's a bug, and you're kind of screwed, and it can completely wreck your protocol. And I think they've kind of made it right, and they kind of survived through it, but it did a lot of damage. And then a good example of even off-chain voting going wrong by perhaps the stakeholders still not understanding like the legality behind what the consequences of what they're voting for is last week. Yield Guild Games, YGG, who was a investor in Merit Circle. So when you're a seed investor, you sign a SAFT, which is a simple agreement for future tokens, saying, okay, I invest $1,000 into your protocol for 10,000 tokens, and then in a year they vest, I get them back, and yeah, I make money. We're all happy. Um, in this situation, Merit Circle decided that Yield Guild Games was not a value add investor, and they weren't really doing a great job at being a VC, and there was nothing in the SAFT in like the agreement signed saying that like they needed to be a hands-on VC, but the community decided, hey, we don't like you, and even though YG and this was I think pretty close to when the tokens were actually going to vest, and YGG would actually be able to realize a 30x return on their initial investment, right? Like you invest in a startup and then they go public and you make a lot of money and you're happy. They got rugged basically. The Merit Circle governance decided that no, you don't get those tokens, and so they canceled the SAFT, the SAFT, and so YGG, they just it's like their initial investment never happened, and so the community liked it because they don't have another VC to dump vested tokens, but legally that's a huge gray area because that is a off-chain legally bound contract saying, hey, we invested and we have a right to these tokens. And then a DAO voted saying, hey, no, you no longer have a legal obligation to those tokens, even though like what happens on chain within the DAO is not legally binding. Like it's just a bunch of Anons voting for something.
Yeah.
And that's an interesting situation. And I believe they kind of settled again off chain because part of the SAFT suggested that one of the clauses was like, Merit Circle has some right to ownership over the tokens regardless of whatever. So they didn't have like a full legal recourse, but it was a very interesting case study in like what kind of legal powers does a DAO have, and those implications need to be understood before you make these kind of like big decisions voting on chain. And so, yeah, there's a lot of kind of iffy situations that could possibly come up.
It's bad. I saw that. That was a really interesting thing to see. It kind of reminded me of Mark Cuban. Everyone was kicking off. You remember Mark Cuban getting rugged earlier this year?
Rubbed by iron.
Yeah, and he just like threw his toys out the pram, and you're like, that's what happens. Like you need to be careful. I wonder if we'll see in the future if we see these kind of SAFTs or we see a format of this take place on chain. So if we see that contract in the form of an NFT, if we see some sort of receipt token that, if they pay out, they have to trade those back in return or something like that, a redeemable token somehow that like reinforces these things. Maybe we'll see that take place in the future. I don't know. But it does go to show that one, sometimes there is power that, these protocols can bring to bear, and two, that it is literally sometimes just a bunch of anons who decide, hey, no, this is not happening, for whatever reason, and it actually goes through. As bad as that is to see, it's also in a sense nice to see that people can utilize that power in a way. It's never nice to see anything like this take place, but it's definitely interesting to see. That's for sure.
Yeah, and I think this combined with everything we've seen in DeFi and DAO governance in the past couple of years, it really just goes to show you that we're still figuring all this stuff out. Like, people complain, oh, crypto's been around for 12, 13 years, and like what value does it have? Like what we haven't solved all these problems and stuff. And yeah, like the kind of the fundamental kind of technical problem of blockchain has taken up most of that time in just development work. And that's why it's only been in the past like year or two or three where we've really seen like application layer stuff taking off with DeFi, NFTs, and DAO governance. But 2 years it's not enough time to come up with the perfect solution for these things.
No.
So it will just take time. I mean, in the past couple of years, we've also seen DeFi protocols go from, Compound again, liquidity, inventing like liquidity mining, and then having massive emissions to liquidity mine, and then you have other new solutions like Olympus's bonds and high APR to try to like three people into providing liquidity, and then you have stuff like Tokamaks doing now with ACC, where you have revenue in the form of people depositing stuff and getting another token in return. And so you're starting to see just now much more sustainable models for like token emissions and stuff. And that's just part of the iteration, right? That's part of working in tech, is building on the shoulders of the people before you, and that applies to governance as well. We started with flat structures perhaps being what we thought was the ideal, and now we're kind of going full circle back to a traditional corporo hierarchy where you have perhaps the core team, a bunch of people above that, and a standard kind of hierarchical structure. And the joke is that like crypto is like speed running thousands of years of finance, and perhaps we'll also speed running thousands of years of governance structures, and we will come full circle back to a representative democracy or a typical corporate hierarchy, because that's what's worked for hundreds and thousands of years.
I was going to say, people are so eager to destroy institutions and systems that they see as old. There's a reason why they've persisted. There's a reason why they're still there, is because they work, and we haven't got many solutions that are better than that, right? Which is why they've been around for long. So, one, you can't just see everything that's old or is institutionalized as a bad thing. But I do believe that the iterations that we're seeing are kind of starting to become digitalized, decentralized, more efficient, more ethical ways of doing these things, and we can just translate them. We can just start to iterate on top of them. And so you may not see vastly different structures, but the way they operate, their underlying fundamentals will have changed. And I think that is going to be a nice thing to see. That's, I think, is what we're starting to see, but we have to have these stress tests. We're so early, like you said, we're so early in this process. And I think, these things don't happen quick. Ethereum's merge, is a case in point. They don't happen super quick, and they shouldn't. They really shouldn't, because we just see huge blow-ups. Not the best thing. And like I say, once things are in code, if you have certain limitations, you can just sit back and watch the destruction until you have the chance to change things. That's a point as well. Is the different ways to control token voting. There's different solutions. That's one of them. Is this a token lock for X amount of time, or between voting, a vote is proposed, but only tokens that have existed in wallets or wallets that have held these tokens for X amount of time, say 60 days, can participate. So you don't get these huge influxes of capitals to manipulate the vote, or capital to manipulate the vote, and then suddenly the outflow. So you don't get this massive manipulation taking place. So there's different ways of doing it, which is very interesting. But that's enforcing it, like putting locks on liquidity is a way of doing it. The idea behind that is
aligning long-term token holders with the governance. Because why would you lock up your tokens for 4 years and then vote for something that's not in the best interest of the value of the token or the value of the protocol? But then ways against that are things maybe like Convex, which kind of centralize vote locked power, and they have a massive holding and they can kind of vote on things in their own interest. Or we had that core AMA spotlight with Paladin, whose kind of one of their products is, it's kind of like a governance lending pool. So you deposit collateral, say in the form of Ethereum, and then you can withdraw a bunch of governance tokens and have short-term governance power on demand over whatever protocol you withdraw from that pool. And so that kind of allows you to maybe bypass the issue of like acquiring governance power. And so it's this huge cat and mouse game in crypto of all the like vote lock tokens being created, and then liquid wrappers around those vote lock tokens being created. So it's like every solution someone comes up with a an anti-solution for it. But it's all very Darwinian, right? Survival of the fittest. And like I said, like we're speed running thousands of years of governance and financial building, and that's part of it is just like the ego of the builders involved. Like we want to think that we can do it better than these standards that have been set in the real world for the past millennia, and we have to be proven wrong. We have to come to terms with the fact that we have to try it all and fail again, and then come to the solution that even if it is the same as what has already existed, our egos have to kind of be checked in that regard, so that we come to these realizations on our own. And but yeah, it's survival of the fittest. And yeah, if we have to do the whole evolutionary process on a speed run, that's what's going to take.
Yeah.
But it is the best way perhaps to validate our assumptions that these things are the good way of doing it, and the best way to doing it is to try and fail again.
Yeah,
until you get it right.
It's these mercenary protocols or mercenary capital liquidity locus that we see take advantage of it, and it is a question of who can outpace those like mercenaries. That's the difficult thing to do. Paladin is a protocol example of that. I'm not to say it's good or bad, but it's a version of it, and people will do whatever they think gives them adequate incentives to do so, and often that comes in the form of yield. So it's a question of, okay, I can get X amount, I vote, I get the bribes maybe, or I can vote in a way that's going to benefit me else, another way, and then they can kind of get their receipt, or they can do whatever. So it's just like you say, it's Darwin until the wheels come off, and we see what's standing afterwards, I guess. Certainly after the next year or two, maybe we'll see what's standing.
Yeah, and I think that's a good place to kind of wrap it up. Is that it's a bit of a meme to say, but the bear market is the best time to build and wipe out all the froth, and to really focus in on what assumptions have we been making over the past couple of years in this very frothy bull market, where almost anything works, right? You could promise someone 20,000% yield, and people will ape into it and go. And that, like, now is the time for proper structures, proper emission schedules, proper protocol mechanics and stuff to really prove themselves that they can stand the test of low liquidity environments, low attention environments. And this is, maybe it's maybe a good analogy is like when you're forging a sword, right? The bull market is heating it up in the kiln, hammering it down, kind of forging the structure, and now we're quenching, right? We're seeing if that steel is brittle or if it's strong. And so yeah, the next couple months, years, however long this bear market takes to shake out, will really be the time to tell, like, separate the wheat from the chaff and see what's going to be left standing at the end, because the protocols that are left standing at the end of this are going to be the ones that have really stood the test of time and really the endured.
Absolutely. And anyone who's been listening, hold tight in Goblin Town, and R.I.P. Tetra. We'll see you again, I'm sure.
Yeah, curious the story behind that. But yeah,
there's
thank you very much, Ouija, for your time.
You're welcome. Thank you.
Yeah. All right. Yeah, take care, everyone. Thank you for listening.